Okay, let's unpack this. We've been living in a market where, all the headlines are dominated by just a handful of these high-flying growth stocks. They
Mhm.
promise these fantastic, sometimes triple-digit gains, but they pay zero dividends. Every penny goes right back into scaling up.
Right.
It's incredibly easy to get caught up in that race for the quick spike. But when everyone's chasing that explosive growth, what essential long-term strategy are we forgetting?
We're forgetting passive income, that reliable stream of cash that just shows up in your account.
Right.
Whether the market's having a great day or a terrible year, it's the income you collect without lifting a finger.
Exactly. And that is why we are doing this deep dive today. Our mission is all about passive income, and specifically through the most reliable, battle-tested stocks you can find.
Dividend Kings.
We're going to extract the crucial facts about this very specific, very dependable type of payer.
And, the core benefit here goes beyond just the money. It's almost psychological. When you own one of these stocks, you get extra cash deposited right into your account.
Mm-hmm.
And that's vital for long-haul wealth building. Those recurring payments, the dividend, they add to your gains when times are good. But critically, when the market dips,
Which it always does.
it always does, those dividends limit your losses and provide a cash floor. It helps you stay calm and avoid panic selling.
It's stability when everything else feels unstable. So let's get specific. When we say Dividend King, what's the actual criteria?
It's an incredibly high bar.
Because we hear dividend stock tossed around for pretty much anything that pays one. What's the definitive benchmark here?
A dividend king is really the ultimate marker of commitment and resilience. We're specifically looking at companies that have increased their dividend payments for at least 50 straight years.
50 straight years.
Not just maintaining a payout, but consistently increasing it for half a century. Through recessions, wars, high inflation, you name it. Yeah.
That kind of consistency is it's unheard of in today's economy. It shows this deep commitment to rewarding shareholders, really across generations.
It forces you to look at a company's history, not just its latest quarterly report.
Okay, that's our foundation. So let's dive into the gold standard here. We've structured this around 3 different ways you can approach building passive income. And we're starting with the longest-running champion in our source material, the master of the brand moat, Coca-Cola.
Coca-Cola, ticker KO. It's a phenomenal example of a business that built a wall around its products, a moat.
Right.
And while everyone knows the cola, the company actually sells a huge portfolio. We're talking over 200 brands for sparkling drinks, water, juice, coffee.
It's a total beverage company.
Exactly.
And this is where it gets really interesting for income investors. They've been around for over 130 years. That history, plus being the biggest non-alcoholic beverage company in the world, has let them build what the source material calls a significant brand moat.
And that's key. Essentially, if you want a Coke, you probably won't just grab something else off the shelf. The craving is specific.
Right, you want a Coke.
And that dominance translates directly into their Dividend King status. They've increased those payments for more than 60 consecutive years.
60?
Think about that. They were increasing dividends while people were still recovering from the Korean War.
That's a staggering run. But how do they sustain that? I mean, we get the brand, but what about the actual cash mechanics?
So this is where profitability comes in. Coca-Cola is, in many ways, an asset-light business. They sell the syrup concentrate and the brand identity.
Ah.
That model gives them massive pricing power. If you look at their gross margins, the profit they make before operating costs, it sits at around 61.5%.
Wow, 61.5%. That's incredibly high.
It's exceptional for a consumer goods company.
So for every dollar of revenue, they're keeping over 61 cents to cover their costs and, most importantly for us, fund that dividend growth.
That's the engine. That high margin generates immense reliable cash flow. And then they use that to incrementally increase the dividend year after year.
And looking at the numbers now.
Right now, you're looking at a dividend yield of 2.9%. That works out to about $2.04 per share per year.
And we should point out that 2.9% yield is higher than the S&P 500 average. So you get an income advantage right away.
You do.
This is a huge company, a $303 billion market cap. It's just true resilience.
I'd call it a foundational holding. It gives you the stability and income to maybe offset some higher risk growth plays you have somewhere else.
A foundational holding. I like that. Okay, let's pivot. From brands you buy because you want them to products you buy because you need them.
The healthcare sector.
Exactly. We're looking at a company that builds its security on diversification. Abbott Laboratories, ticker ABT.
Abbott is a textbook case for how a diversified model builds safety for investors, which in turn protects the dividend.
So it's not just one thing.
Not at all. It's a healthcare giant. But its strength is that it operates across 4 distinct areas: medical devices, nutrition, diagnostics, and established pharmaceuticals.
And the genius there is the built-in safety net, right? If one sector, say medical devices, has a tough year.
Exactly. The other 3, like nutrition or diagnostics, can keep performing and limit the overall damage to earnings. It's all about dividend protection.
That makes sense.
And that internal resilience has let them deliver very consistent earnings growth over time. They're market leaders in things like diabetes management and nutritional products. This is essential demand.
So how does that translate into their Dividend King status? What's the streak?
It's an extremely resilient streak.
Right.
Abbott has increased its dividend for the past 53 years.
53. So they comfortably clear the bar.
They do. And it shows they can pivot through massive changes in medical tech and public health crises.
Okay, but let me play devil's advocate for a second here.
Late.
Healthcare just feels so, I don't know, sensitive to regulation, patent cliffs, politics. How secure is that 53-year streak, really?
That's a crucial question. And the answer is diversification. Yes, any single product can face pressure, but they're constantly generating new patents in pharma and devices while also relying on stable, recurring revenue from things like diagnostics and nutrition.
So they spread the risk?
They spread the risk. Their gross margin is lower than Coke's, but it's still a very robust 52.09%.
Which reflects the R&D and complexity of what they make?
Precisely. But because people need their products, whether the economy is booming or busting, the demand stays high.
And the financials on Abbott?
The current yield is 1.9%, which is $2.36 per share. And like Coke, that's higher than the S&P 500. It's a large, stable, $218 billion market cap company. The story here is security through necessity.
A great defensive anchor. Okay, that brings us to our third and final example. This one is, well, it's a bit more complex. A potentially higher reward scenario.
The recovery play.
The high-yield recovery play. This requires a little more nuance, maybe a higher risk tolerance. Let's talk about Target, ticker TGT.
Target is an interesting choice. It's maybe counterintuitive for this list because, as our source material notes, it's been a tough stock to own recently. They had huge inventory problems after the pandemic, supply chain issues, fierce competition. It really hammered the stock price.
So the context is vital. This is not a defensive play like the others.
Not at all. It's a turnaround story.
But the company is actively addressing those problems. They're focused on efficiency, margin recovery, and they're even transitioning to a new CEO. The market tends to like decisive moves like that.
And the investment angle here is really about valuation. Because the stock has struggled, it's trading for just 12 times forward earnings estimates.
And just to put that in perspective for you, the listener.
Right. Competitors like Walmart or Costco often trade at much higher multiples. So Target is positioned as a bargain.
Okay, so you're buying the potential for recovery at a discount. But what's the assurance that the dividend is safe if things get tougher? I mean, retail is brutal.
The bedrock here is their fundamental asset base. They have 2 major growth drivers. First, this massive portfolio of billion-dollar owned brands like Kite and Jack.
Which have higher margins.
Much higher. And second, and this is maybe the most innovative part, is their evolving in-store fulfillment network.
Okay, that last part, the fulfillment network. That sounds like jargon, but I'm guessing it's a key piece of the puzzle.
It's absolutely key. Think about it this way. Target leverages its physical stores as mini warehouses. This allows for super efficient services like same-day delivery and drive-up.
Ah, I see.
By routing online orders through the store closest to you, they slash those expensive shipping costs that plague pure e-commerce companies.
So they're turning a potential liability, all those big stores, into a logistics advantage.
Exactly.
Yeah.
Now, because they're a retailer, their gross margin is much lower than the other two. It's about 25.36%. But despite the lower margins and recent struggles, the commitment to passive income is rock solid. Target has lifted its dividend for 54 years.
54 years. Through the rise of Amazon, multiple recessions. That is remarkable for retail. And the payoff for taking this risk.
It's significant. Target pays $4.56 per share. That gives it a really high yield of 4.9%.
Wow. Yeah, that's dramatically higher than Abbott and Coca-Cola.
And that 54-year track record is the anchor. It shows the depth of their commitment to shareholders. It proves they can and will keep increasing that payout even when things are tough. That's what makes it a compelling recovery story at this valuation.
So to synthesize this for you, the listener, we've got three major players: the brand resilience and cash flow of Coca-Cola, the diversification and defensive security of Abbott Labs.
And the high-yield recovery play with Target.
The main takeaway is that whether you're looking for brand dominance, safety, or a bargain, the common thread is the power of that Dividend King designation, that 50-plus year commitment.
It signals a level of financial health and management focus that's just extremely rare today.
Absolutely. This has been a great breakdown, cutting through the noise to focus on proven income.
But let's leave you with one final thought to sort of mull over. We've seen these three kings have vastly different sizes and profit models.
Right.
Coca-Cola's huge, $303 billion market cap, sky-high 61% gross margin. Abbott is smaller, strong margin. Target is the smallest at $44 billion with the lowest margin.
The margins just tell the story of their business model, really.
Exactly. So this raises a question for you to consider for your own portfolio. What combination of that long-term dividend reliability and a specific business metric? Is it the high gross margin that guarantees cash flow? Or is it the lower PE ratio that promises stock appreciation? Or is it just a massive market cap ensuring stability?
Which metric is most critical for your own personal goals?
You need to explore how the sector affects these critical numbers before you decide which king is right for your passive income strategy.
That's the ultimate test for the informed investor. Thank you for walking us through this essential breakdown.
My pleasure.
And that concludes our deep dive into the Dividend Kings. We hope you feel a little more prepared to start building that foundational long-haul passive income portfolio. We'll see you next time.